Are you curious about how President Trump's latest tax proposals might impact your finances? Let's break down the key changes and what they mean for you. In this video, I'll explain the most significant tax reforms proposed by the Trump administration and how they could affect individuals and businesses alike. The proposals include major shifts like extending previous tax cuts, altering corporate tax rates, and closing certain tax loopholes. I'm Brad Paladini, a tax attorney with over a decade of experience helping clients navigate complex tax laws and stay informed about policy changes. The first key proposal of the Trump administration is to extend the 2017 tax cuts and make them permanent. The Tax Cuts and Jobs Act of 2017 introduced lower tax rates for most individuals and corporations, but many of those provisions are set to expire in 2025. The current proposal aims to extend these cuts indefinitely, which potentially would add $4 to $5 trillion to the national debt over the next 10 years. This could mean continued lower taxes for individuals and businesses, but also raises concerns about increasing the federal deficit. In addition, there are proposals to change corporate tax rates. The proposal includes reducing the corporate tax rate from 21% to 20%, with a further reduction to 15% for companies that manufacture in the United States. This aims to incentivize domestic manufacturing, but again could lead to decreased federal revenue and an increase in our deficit. The administration is also targeting the carried interest loophole. What does that mean? Well, the carried interest loophole basically allows private equity and hedge fund managers to pay a lower capital gains tax rate on their income. The proposal seeks to tax these earnings as ordinary income, potentially increasing tax rates for fund managers. Now, this is one of those loopholes where everybody or almost everybody who isn't a private equity or hedge fund manager agrees it should be closed. But as you can imagine, private equity, hedge fund, pretty powerful people, and they have fought very hard to keep this loophole open. We can't talk about tax changes without talking about tariffs. Of course, all of the news lately has been on shifting trade policy. The administration is currently implementing and plans to implement more tariffs on imports. This could lead to higher prices for imported goods and potentially retaliatory actions from trade partners. Let's walk through kind of what a tariff is and why it could lead to higher prices. I have a home gym. I love home gym equipment. One manufacturer out there that's pretty popular, it's called Fringe Sports. They're a US company, but they manufacture their equipment, I believe, in China. The owner did a video recently kind of explaining how this would impact the business. So this is a US company who purchases and manufactures the products overseas. If tariffs are imposed or if tariffs increase, it is the US company who actually pays the tariff. So while it's a tariff on Chinese goods or whatever country's goods, it is the company in the US who imports these goods who pays the tax. And of course, if they are paying higher taxes, they are most likely passing along that additional cost to consumers. And that's what the owner of Fringe Sports was explaining in his video. Given his profit margins and everything that's going on, he really has no choice but to raise prices in order to remain profitable. Now, the idea with tariffs is that if you increase tariffs on products that are imported overseas, hopefully those products will begin to be manufactured in the US. That is at least the theory. So what are the potential implications of these tax cuts for individuals? Well, the big pro is potential for continued lower income tax rates if the 2017 cuts are extended. The major con is that by decreasing revenue, by continuing with the tax cuts, you could see a reduction in government services from that decreased revenue and also an increase to the national debt. For businesses, pretty much the same. You could see lower corporate tax rates, especially if you are a domestic manufacturer. The con is potential increased costs for industries affected by tariffs. And again, if the corporate tax rate is cut, you could be looking at less revenue to the US government and an increase in our deficit. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more updates on tax policies that could affect you.